In 2022, the West froze $300 billion of Russia's sovereign assets. In 2024, India quietly airlifted 100 metric tons of its gold out of London. And just last month, in October of 2025, after the US government seized $15 billion in Bitcoin from its nation's largest conglomerate, the government of Cambodia reportedly began moving 10 tons of its national gold reserves to a vault in China. Now, this sounds like a geopolitical chess game. It sounds like something you'd see on the nightly news that feels a million miles away. It's the business of presidents and prime ministers and central bank governors. But what if it's not? What if I told you this isn't a geopolitical story? What if I told you this is a fire alarm, a final warning signal for your bank account, for your 401k, for your pension? What if I told you that these governments, these powerful sovereign nations, are all running from the exact same threat, a threat that is aimed directly at your retirement savings? These nations are not fleeing politics. They are fleeing a single fatal financial risk. It's a $2 term for a multi-trillion-dollar problem. It's called counterparty risk, and the lesson these nations are desperately trying to teach us might be the only thing that protects your life savings from the next inevitable financial crisis. Translating the fear. What is counterparty risk? I want you to forget Russia and Cambodia for a moment. I want you to think about your money. The money you worked 40, 50 years to save. The money you are counting on for your retirement. Where is it right now? Most of us would say, it's in the bank, or it's in my 401k, or it's in my pension. Now let me ask you a very different question. Do you own it? You think you do, but you don't. When you deposit money in a bank, you do not own that money. The moment you hand it over, the legal definition of that money changes. It is no longer your property. You become an unsecured creditor to the bank. You have given the bank a loan, and in return, they have given you a promise to pay you back when you ask for it. Russia had $300 billion based on that exact same promise, a promise that was broken overnight by a political decision. What about your 401k? Those stocks, they are not in your name. Look at your statement. They are almost certainly held in street name. That means your brokerage firm is the legal owner. You are the beneficial owner. Again, your entire retirement is based on their promise to do the right thing. What about your pension? A pension is the definition of counterparty risk. It is an IOU. It is a promise from a former employer or a government that they will have the money to pay you 20 or 30 years from now. All of it. Your bank account, your retirement fund, your pension. It is all just a series of promises, a web of digital ones and zeros held by a third party, a counterparty, and counterparty risk is the risk that the person on the other side of that promise, the bank, the broker, the government, either cannot pay you or will not pay you. This is the fear that is shaking the foundation of the global financial system. We just saw it confirmed in October 2025. The US government, in its case against the Prince Group, didn't just freeze a bank account. They seized $15 billion worth of Bitcoin, an asset that was supposed to be decentralized, an asset that was supposed to be outside the system. It proved that if a third party can be identified, if a government can access the on-ramps and off-ramps, nothing is truly safe. If a sovereign nation like Russia can have its savings evaporated, if a Bitcoin whale can have his digital vault emptied, what does that mean for you? It means our entire financial system is built on a foundation of trust. And the insiders, the smart money, are now showing us that this foundation is crumbling. The elite's confession: if you want to know what's really happening with the economy, you don't listen to the talking heads on television. You don't listen to the politicians. You don't even listen to what the Federal Reserve says. You watch what the Federal Reserve does. You watch the ultimate insiders, the central banks. These are the people who run the casino. They invent the rules, they print the chips, and for the last 50 years, they have been running the greatest contradiction in financial history. Here is what they tell you. They tell you, you must trust the US dollar. They tell you, your savings are safe in the bank. They tell you, inflation is transitory, or inflation is 2%, even as your grocery bill tells you it's 20%. They tell you that gold is a barbarous relic, a pet rock, an old useless metal that has no place in a modern portfolio. That is what they tell you. Now here is what they do for themselves. While telling you to stack paper dollars, they are buying physical gold, and not just a little. They are buying it at the fastest, most aggressive pace in 70 years. In 2022, 2023, and 2024, central banks around the world went on a historic buying spree. China, Poland, Singapore, Turkey, India. The list goes on and on. They are running, not walking, to convert their paper dollars into hard, physical, non-political money. Why? Why would they do this? Why would the very people who print the money, the people who benefit from the paper system, be desperately trading that paper in for a block of metal? The answer is terrifyingly simple. They are doing it for the exact same reason Russia and India and Cambodia are. Because physical gold has no counterparty risk. Think about that. A bar of gold in your hand or in your vault. It is not a promise. It is not an IOU from a politician. It is not a liability on anyone else's balance sheet. It is the only financial asset in the world that is not simultaneously someone else's debt. The people who run the system, the people at the Federal Reserve, the people at the Bank of England, the people at the European Central Bank, they are all publicly promoting their paper currency, while privately hoarding the one asset that cannot be printed into oblivion. This is not a conspiracy theory. This is a confession. It is an admission in broad daylight that they no longer trust the long-term survival of the very system they created. They are preparing for a failure they are asking you to ignore, a failure they are asking you to pay for. They are quietly abandoning their own system, and they are leaving you, the retiree, the saver, to go down with the ship. I'm going to tell you the single most important rule in finance. It's the thesis for this entire video. If you cannot hold it, you do not own it. Russia learned this lesson with its $300 billion. Cambodia is learning this lesson right now. But many of you watching this, sitting in America or Canada, are thinking, that's a geopolitical risk. That's something that happens to other countries. It can't happen here. I'm here to tell you that it has happened here, and the laws are already on the books for it to happen again. Let's go back in time. The year is 1933. The United States is in the depths of the Great Depression. The banking system has collapsed. People are terrified, and they are doing the one thing that makes logical sense. They are pulling their money out of the failing banks and holding it in the safest form they know, physical gold. But the government had a problem. The Federal Reserve needed that gold to back the currency it wanted to print, to inflate its way out of the Depression. So on April 5, 1933, President Franklin D. Roosevelt signed Executive Order 6102. This order made it illegal for any American citizen to own physical gold. It wasn't a request. It was a criminal offense, punishable by 10 years in prison. This wasn't a confiscation in the way you might think. It was, in legal terms, a forced sale. Every single American, from farmers to small business owners, was ordered to deliver their life savings in gold, their coins, their bullion, their gold certificates, to the nearest Federal Reserve Bank. In exchange, the government paid them $20.67 for every ounce. The government used the threat of prison to force its citizens to sell their real money for paper money. But here is the sting. Here is the betrayal. After the government had successfully gathered the nation's gold, after the vaults were full, Congress passed the Gold Reserve Act of 1934, and with the stroke of a pen, President Roosevelt revalued the price of that same gold to $35 an ounce. Let me say that again. The government forced you to sell your gold at $20. Then, months later, it declared that gold was now worth $35. An instant 70% profit for the government, an instant 70% loss of purchasing power for every person who obeyed the law. They stole your wealth, legally. So when you tell me, it can't happen here, I tell you, it did happen here. Your own government has already proven that in a crisis, the rules of private property can and will be suspended. But that was 1933, you say? That was a long time ago. They wouldn't dare do that today. You're right. Today they have a new tool. It's far more sophisticated, and it's far more dangerous. It's called a bail-in. You see, everyone remembers the 2008 financial crisis. We all watched as the too-big-to-fail banks, the ones who caused the crisis with their greed and gambling, were given trillions of your tax dollars. It was called a bailout. You, the taxpayer, were forced to rescue the billionaires who destroyed the economy. The public was furious. The political backlash was enormous. So the G20, the leaders of the world's largest economies, got together. They said, we must never have another taxpayer bailout. And instead, they created the bail-in. What's the difference? A bailout is when taxpayer money from outside the bank is used to save it. A bail-in is when the bank uses the money of its own creditors, money inside the bank, not to save itself. Now, who are a bank's creditors? Stockholders, yes. Bondholders, yes. But also, you, the depositor. You are the bank's largest unsecured creditor. This is not a theory. This is the test run. March 2013, the island nation of Cyprus. Its banking system was collapsing, poisoned by bad Greek debt. The banks shut their doors. ATMs were locked. People with 50,000 euros, 500,000 euros, woke up one morning to find their life savings were gone. The government, as part of its bail-in agreement, simply seized the money. Now, to be precise, the insured deposits, in those under 100,000 euros, were protected. But at the Bank of Cyprus, the nation's largest bank, every dollar over that 100,000 euro limit was subject to a haircut. Depositors woke up to find that 47.5% of their savings had been forcibly converted into worthless bank stock. Their cash was gone, vanished, sacrificed to save the bank. And in that moment, the entire world learned the new rule. Your deposits are no longer sacred. They are now considered capital to be used in a bank's rescue. And this is the part where I must warn you. This is not a story about Cyprus. This is a story about you, because that bail-in mechanism is now the law in the United States and in Canada. You heard me correctly. When Congress passed the Dodd-Frank Act after the 2008 crisis, they embedded this mechanism deep inside Title II. It's called the Orderly Liquidation Authority. It gives the FDIC the explicit legal power in a systemic crisis to execute a bail-in, to take the assets of a failing, too-big-to-fail bank and convert its debt, which includes your uninsured deposits, into equity, to save the system. And for my viewers in Canada, it's the exact same story. In 2018, your government quietly enacted the bank recapitalization bail-in regime. It gives the CDIC, your national deposit insurer, the same power. The power to take the savings of creditors to prop up a failing bank. This isn't a foreign risk from Russia. This isn't a history lesson from 1933. This is the active legal framework of your own country. This is the ultimate counterparty risk. The rules have been changed while you were told everything was fine. They have legalized the seizure of your deposits to save the very system that the central banks are now quietly fleeing themselves.